Bank of England raised interest rates to the highest level in 9 years. Mark Carney once again weighs in on the Brexit debate. The Fed keep interest rates unchanged. Non-farm payrolls come in below expectations. Welcome everyone once again to another edition of Rational Thinking. My name's Nathan, I'm one of the corporate dealers here at Rational Foreign Exchange, and I'm going to take you through the events of last week and what to expect for the week ahead. We had a big week last week in terms of economic data, but little to show in terms of movement of volatility across the pound, dollar or the euro. It all kicked off on Thursday in the UK with the Bank of England voting to raise interest rates to 0.75%. Initially, there was a bit of a spike to the pound, not so much because of the decision as that was expected by most market participants, but the fact that the voting members voted unanimously 9-0 in favour of raising rates. Despite all the political uncertainty the UK faces as a result of Brexit and the fact that economic growth is likely to remain subdued over the next couple of years, Mark Carney painted a relatively upbeat picture of the UK economy, citing record low unemployment that is expected to fall a little further, slightly improved wage growth and inflation currently tracking above target at 2.4%. In the monetary policy statement, the Bank of England did indicate that any further increases are likely to be gradual in extent. Mark Carney did also say on Friday that he expects that interest rates to increase to around 1.5% over the next 3 years. Once again, Carney copped criticism from a number of prominent Brexit MPs. After an interview with the BBC on Friday, he stated that the chances of a no-deal Brexit were uncomfortably high, and he's also already discussed the risks that he feels that the UK economy faces as a result of a no-deal Brexit. After his comments, the pound sold off on Friday. On Wednesday in the US, the Fed voted unanimously to keep interest rates unchanged. This is despite a strong labour market, solid economic growth, and business and household activity picking up. They did say that they would remain accommodative depending on what happened with conditions, but at the moment it's expected that there will be a 90% chance of an interest rate hike in September and a roughly 70% chance of a further interest rate hike in December. Overall, expectations are that the Fed will gradually raise interest rates over the medium term as the economy continues to grow and inflation stays in and around their 2% target level. On Friday, the US posted solid non-farm payroll figures with 175,000 jobs added last month. This is a little bit below expectations of 190,000 jobs to be added, and as a result, the dollar was sold off and pound dollar pushed back up towards the 130 mark after these figures were released. All Brexit developments aside, a fairly quiet week on the economic calendar this week. We've got UK GDP estimates out Friday morning, and in the afternoon we've got US inflation figures expected to come in unchanged at 2.3%. Thank you once again for tuning in to Rational Thinking this week. Should you have any questions or queries, please feel free to contact us on the details provided, and don't forget to like or subscribe to our channel.